Welcome to Chapter 6 of the Clever Framework, where we explore the fifth essential step, examine logic and consistency. You've clarified your question, looked for missing information, evaluated your sources, and verified the calculations. But there's one more critical test. Do the numbers tell a coherent story? Correct numbers don't guarantee correct conclusions. Statements can be numerically accurate and still be logically flawed. This chapter pushes you beyond technical accuracy to assess whether conclusions align with evidence, whether the story holds together, and whether results reflect both accounting knowledge and economic reality. Logic is the guardrail that keeps analysis from drifting into unrealistic or unsupported claims. A student analyzes a company's financial statements and concludes that the business is financially strong because it reports steadily increasing net income over 3 years. She emphasizes the upward profit trend and recommends it as a low-risk investment. But she never questions why retained earnings have barely changed over the same period or why total liabilities have grown faster than assets. When the instructor asks if profits are rising, where did they go? She revisits the statements and realizes the company has been paying out nearly all earnings as dividends while simultaneously taking on significant debt. Her original conclusion wasn't based on incorrect numbers. The figures were accurate, but on reasoning that failed to logically connect performance, financing decisions, and financial position. The issue wasn't the calculations, but the logic and consistency. This is exactly why examining logic matters. Accurate numbers can still lead you to completely wrong conclusions if you don't test whether the story they tell actually makes sense. Professionals face the same challenge, often buried beneath more complex data. During a review of quarterly results, a senior analyst sees a company report rising profits, shrinking expenses, and strong operational performance, all while cash flow from operations has sharply declined. Rather than celebrating the apparent success, she pauses and asks the critical question, how can operational performance be strong if operating cash flow is collapsing? The narrative doesn't match the underlying economics. Something is inconsistent. Her skepticism triggers deeper analysis that eventually uncovers a buildup in uncollectible receivables that management glossed over in their presentation. Management's explanation was incomplete and the logic was flawed. This scenario illustrates that correct numbers do not guarantee correct conclusions. Her professional skepticism, specifically her examination of logic and consistency, prevented what could have been a costly mistake. Let's position this step within the full Clever framework. You've clarified the request to understand what you're actually evaluating. You've looked for missing information to see what's been omitted. You've evaluated the source to assess credibility and motives. You've verified the math to ensure numerical accuracy. Now at step 5, you examine logic and consistency to ensure conclusions align with accounting principles and economic reality. This step requires you to test whether results make sense, whether relationships across statements are coherent, whether trends fit expectations, and whether any contradictions or conceptual errors undermine the narrative. Logic and consistency matter for 4 critical reasons. First, it guards against misleading confidence. Numbers can be accurate, yet tell a false story if the logical connections are wrong. Second, it exposes hidden conceptual errors, correct calculations that can mask flawed reasoning about how accounting actually works. Third, it prevents narrative manipulation. Optimistic language often obscures contradictions between what is claimed and what the numbers actually show. And fourth, it protects decision quality. Incomplete analysis that fails logical tests lead to faulty conclusions that can harm businesses and stakeholders. Accounting is grounded in structure and logic. Financial statements follow predictable relationships. Economic events follow patterns, and accounting principles exist to ensure coherence. When conclusions break these patterns, something is wrong. Examination of logic confirms what the earlier steps of Clever have identified and uncovers issues that calculations alone cannot reveal. There are 6 essential tests you should apply to examine logic and consistency. First, do conclusions follow evidence? Does the stated conclusion match supporting data or does one strong quarter become the most profitable in industry? Second, check internal consistency. Do statements tell a coherent story? Because rising profit with declining cash demands investigation. Third, assess reasonableness. Does this align with industry norms? Because 800% quarterly revenue growth is highly suspicious. Fourth, identify logical impossibilities. Profit when expenses exceed revenue or cash in the liability section are immediate red flags. Fifth, verify cross-period consistency. Do trends have plausible explanations? Because equity declining while net income is positive requires reconciliation. And sixth, compare claims versus reality. Does evidence justify the optimism, or are risks understated without basis? These 6 tests work together to ensure that the story your numbers tell is not only mathematically correct, but also logically sound and aligned with how businesses actually operate. Let's examine a scenario that demonstrates logical inconsistency. A company reports net income of $150,000, up from $120,000 the previous year. That looks positive. But cash flow from operations is negative $35,000, down from a positive $20,000. Revenues and expenses are both stable. At first glance, the income increase appears positive, but logical analysis reveals serious problems. A company with rising profit and stable revenue and expenses should normally show consistent or improving operating cash flows, not a sharp decline. The statements are internally inconsistent, and this contradicts business reality. Possible explanations include uncollected receivables building up, inventory increasing and tying up cash, or distorting adjustments like gains that inflate net income. Profitability without cash inflow often signals liquidity stress. This example shows that contradictory trends demand deeper investigation before accepting the narrative. You can't just look at net income in isolation. You must test whether it logically aligns with cash flow and other indicators. Here's another example showing how AI can generate logical contradictions. A student asks, why did Brightwave have lower expenses this year? The AI responds, expenses decreased because they invested in automation. Overall expenses increased due to supply costs, but this represents a cost reduction. At first, this sounds thoughtful, but examining logic reveals 3 major problems. First, the AI claims expenses both decreased and increased. That's circular and unclear. Second, heavy equipment investment typically increases expenses through depreciation, not decreases them. Third, the explanation confuses capital expenditures, which affect the balance sheet, with operating expense reductions on the income statement. The AI's response doesn't align with accounting principle and contains internal contradictions. Even when AI sounds confident and authoritative, logical testing uncovers conceptual errors. This is why human judgment is essential. You must reconcile the reasoning and test whether explanations actually follow accounting logic, not just accept them because they sound plausible. Let's review 6 common mistakes people make when examining logic. First, trusting correct numbers blindly. Accurate calculations can still yield illogical conclusions if relationships are inconsistent. Second, ignoring contradictions. Strong performance paired with declining cash flow demands immediate investigation. Third, confusing mechanical versus conceptual accuracy. Spreadsheets may add correctly, but reflect fundamental misunderstandings like misclassified expenses or mixed cash and accrual concepts. Fourth, overlooking economic reality. Results that defy typical business patterns, like claiming zero liabilities, require scrutiny. Fifth, letting language replace logic. Confident phrasing from management or AI can mask narratives misaligned with the actual data. And sixth, failing to cross-check periods. Dramatic trend shifts without explanation demand answers. Each of these mistakes allows logically flawed conclusions to pass unchallenged. By consciously avoiding them and applying systematic logical testing, you ensure your analysis is not only technically accurate, but also conceptually sound. Think of logic as the bridge that transform correct data into reliable insight. You start with verified numbers, accurate and confirmed. Then you apply logical testing to ensure the relationships make sense, the trends align with reality, and the conclusions follow from the evidence. Only then do you arrive at reliable insight, conclusions you can trust and defend. This progression is essential because numbers alone don't tell the complete story. Logic and consistency act as your professional guardrail, preventing analysis from drifting into unrealistic claims or unsupported conclusions. By applying logical scrutiny at every stage, accounting professionals maintain high standards of accuracy and uphold the integrity of financial reporting. This disciplined approach to examining logic is what separates sophisticated analysis from surface-level number checking. Once you've established logical consistency in your analysis, there's one final essential step in the Clever framework. The final step ensures that your data is used responsibly, ethically, and with full awareness of its impact on stakeholders. Logic tells you whether the numbers make sense. Ethics tells you how to use them appropriately. In Chapter 7, we'll explore how to reflect on ethics and professional judgment where logic meets integrity. Thanks for viewing this Clever Framework video. This video has been created and narrated by Dr. Wendy Tietz.